the way, you know, what, I mean, they're so brilliant in their mathematics. And sometimes I read it for the first time, I read it for 2 hours. I say, what the hell is this man or woman talking about? But, but, but okay, so I don't understand it after 2 hours of reading. You know what I do? I back up and I say, is there an element of arch in there, or is there an element of GARCH? So no matter how complicated the equation is, other models of volatility are. If you sit back and say, let me try to recognize in there whether there's arch type or whether there's GARCH type, you will see arch and GARCH type, you know, among the very complicated models. So that's why it's really sufficient to teach the arch and GARCH in this class, okay? And beyond that, next week I'll introduce other more complicated models, a few others, but we shall look in there to see if we recognize elements of arch and GARCH. Okay, so that's the plan. And then beginning next Tuesday, I'll teach for only half the class. The other half of the class, I'll work with you on the project. I'm going to, hopefully I'll assign the project by Thursday or latest early Friday. I'm removing some things. I'm using better language. But then as soon as I post it, then beginning next week, Tuesday, I'll come to class, teach half the class, stop. And the other half, I'll take questions about the project. So I'll encourage all of you to begin the project this week. And then even if you don't have questions, I will introduce some elements for you to think about. That's what I'll be doing beginning next Tuesday. All right. Any questions? Okay. So let me, I'm going to bring up the textbook, okay? I'm going to bring up our textbook, and I'm going to point to some places I need you guys to read, because of course I'll be getting exam questions from those sections. I'm not doing it just because, you know, I want to waste your time. Okay, but this section is quite, you can handle it. You can handle reading it. It's not complicated at all. And whenever, just like I always recommend, whenever you come across a complicated portion, you can skip it at first and then go on. Are you going to? Yes, I'll record the class, Sophia. Thank you. I just want to position it. Okay, good. Okay, you can see it now. So good. I wanted to see if I can see it. All right, so I'm going to record now. Everybody, if you don't, you can stop me anytime.
This meeting is being recorded.
Okay, so hello everybody. Nice to see every one of you again. It is 6:10 now. So I want to begin to introduce us to the latest topic, and it's chapter 4, okay, of your textbook. And it's on page, if you look at up here, it's on page 176 of your textbook. That's the beginning of chapter 4. Okay. The way, usually when I teach, not just financial econometrics, but even when I teach ordinary finance, regular finance, and I want to talk about volatility, you know, it's like I'm going to pour cold water on all of us right now, ice cold water. Because that's why I brought this chapter. So it's looking at us as I discuss. Because let's just figure out what we do in finance. And I'm going to ask everybody this question. For IBM stock, for Microsoft stock, for Facebook stock, what do we really observe in the market? This is not a trick question. Do you and I really observe returns? We look at price, absolutely. Because what exactly do we, if you go to New York Stock Exchange physically or online, and you say, you and I, we want to buy one share of Facebook stock, what are we really, what are we observing in the market? We're observing the price, right? If you look at the ticker tape, or if you look at the whatever medium you're looking at, you're seeing the latest price on Microsoft, on Facebook, on all stocks. You're looking at it, the price per share. then, but we do a lot of our work with returns. But the fact is, we don't really observe returns. Look, this concept is very deep. For many of us, when I say this, you in your mind, you're saying, what the heck is he talking about? Of course, that's obvious. But if you really think about it, hello? When I say, when I say IBM or Facebook gave us 10% return over the past 1 month, or over the past 1 day, or over the past 1 year, can anybody tell me what exactly does that 10% mean? The first thing you have to ask me is, Professor, how did you calculate the return? Okay, for all of us in this class, just somebody tell me, how many types of returns have we used for homework so far?
Two.
Two. What are those? What are those two?
Simple.
Log return and simple.
Simple return and logarithm return. Is that right? And in fact, the logarithm return we use is natural log. Yes, because you know from calculus, from the very hated calculus, there are different types of logarithms, right? There's logarithm to base 10. There's logarithm to base 2. There's logarithm to base e. Natural log is logarithm to base e. I'm sure you remember that vaguely, or many of you actually remember. So even if you want to calculate log return, the type of logarithm you use will determine whether it's 10% return or 15% return or 8% return. You get the point. And then if you use only natural log return, the number, and you tell me it's 10%, well, 10% in natural log will be different from 10% in simple return. So if you use simple returns or log returns, your number could be different. You all agree. So when somebody says, I made 5% return over 1 year ago, you immediately, well, in a nice way, challenge them or ask them, how did you determine that return? Because when you and I go to Wall Street to buy Facebook, we don't really buy returns. We don't buy and sell returns, okay? We don't buy and sell returns. And in fact, Andrew, is typically not a simple return. Yes, if you go to the market and you ask the average Joe, by the way, not me, but Joseph, the average Joe, not my friend Bishop Ann too, but the average Joe in the market, if you go and ask the average Joe, what is the return? 5% is simple return. You're right, okay, Andrew? But Alec, it could be geometric return if you and I are working with, for example, a hedge fund, and we want to be a little bit sophisticated. Or it could be median return, or it could be just DIFF, just difference. We're not dividing. So when somebody tells me return, you know, and I say to myself, number one, are you talking about dollar return or percentage return? And number two, are you talking about simple return or logarithm return? And if it's log, to what base? Okay, log E. Some people do it to log 10. Okay, we can convert from one log base to another, or we can convert from log to simple return. We have all the equations to convert. But the bottom line is, when somebody says, I made 10% return, you don't know. I don't really know what the I wanted to say what the heck they're talking about. I don't really know what they're talking about because nobody observes returns. Absolutely, the only thing we observe is price. That's why, again, some of you get very angry with me. You say, Professor, why do you want us to go to Yahoo and download the price? Why don't you refer us to somewhere else where they have listed the returns? Professor, what are you doing? Do you hate us, Professor? You like to waste our time? What is the simple answer to that? Professor, why do you make us go to Yahoo and pick up prices instead of going to XYZ and pick up return? What is the simple answer to that? Anybody? self-sufficient. But if you go somewhere and download return, what is the question you have to ask about that return?
How are they calculated?
Yes, how are they calculated? I don't know. I don't know if I send you to XYZ database in Chicago. I don't know how they calculate the returns because I don't know. Or even if they did it right, or even if I agree with that method of return. That's why. Okay, that's why. So return is one of those things we don't observe when we buy and sell securities. The only thing we observe is price. Okay, enough of that. What do we mean by volatility, by the way? Can anybody tell us what do we mean by volatility, which is the topic of this class? Well, volatility is we try to represent risk by volatility. In other words, what I'm really interested in is the behavior of the price of Facebook. If you tell me that the price today of Facebook is $50 per share, well, tomorrow, is it going to be 50? Yesterday, was it 50? Day by day for the past 10 years, has it been 50? No. You tell me, of course not, Professor. The price has not been 50. It's been changing every day. I say, huh? How is it changing? Well, some of you will say, well, it's been changing by small amounts. Others will say, well, it's been changing by medium amounts. Others will say it's been changing by not too small amount or big fat amount or a little bit less than big fat amount. And I mean, so all those qualitative descriptions, they do me no good. Okay? That's why we want to say, okay, how risky? The price is 50. If I look one day by day for the past 1 year, has the price been 50, 50, 50, 50 every day for the past every trading day for the past 1 year? If the answer is no, well, how can I represent that answer no? How can I represent the change in prices day by day? Why do I need to represent? Because I need to know whether to buy it for the future, or even if I buy it today, I need to be ready for maybe similar change or average of the similar changes or whatever. That's why we say, okay, how can we quantify that risk? Okay, how can, so let me summarize. First, the only thing we observe is price. Number two, with the price, then I follow up and ask, has the price been constant day by day for eternity? Maybe for 1 year, day by day for 1 year, or day by day for the past 5 years. If the answer is no, the next question is how has the price been changing? Is it like a fantastic roller coaster, or is it just a mild one? Because if I am risk averse, I may want to choose the mild one. If I'm like many of you, you want to make big, you want to go be with roller coaster because you are betting that you will catch it on the upper trend. But not me. So the question is, both you and I, we want a measure of how risky this stock has been. And one measure of risk is volatility. Now, before you think you have understood what I just said, where's my buddy, Alec? Alec.
I'm here, Professor.
Okay, Alec, how tall are you? Well, before you, don't give me any answer, okay? Now, if Alec tells me, Professor, I am 6'2". Well, is that the only, can anybody tell me, not Alec, anybody else, is that the only way Alec can measure his height? You can do it in centimeters, you can do it in meters, or you can even not use units at all. You can say, Professor, just wait. Alec, that's Alec talking. Professor, wait, I am going to turn on my camera and I'm going to go to the corner of my room and I'm going to put a ruler on my head and I'm going to mark off how tall I am on the wall. You see? So there's no unit. I just look at how tall he is and then we'll bring somebody else or two other people to the same corner of the wall, and Alec will, and each of those people will mark off their heights, you know, and then I can compare, oh, Alec is taller than this person, but this person is taller than Alec, and so on and so forth, without even using units. So if you tell me, Professor, I'm 6'2", it's really meaningless to me, Alec, unless I understand what the feet and the inches are. But again, I don't know about many of you, but when I go to Europe these days, I mean, you know, I always have to use my calculator because I was born in Nigeria with inches and feet, the British type system at that time. And then when I grew up and I went to college and I came out to the United States, and then suddenly it's meters. So when I traveled to Europe, anywhere in Europe, I have my cell phone, and then when somebody tells me meters, I punch how many meters you know, how many meters, how many feet or inches representing the meters, and then temperature. You guys are, you know, whenever I go to China or whenever I go to Europe, they use, you're aware, right? They use Celsius, right? And we are using Fahrenheit. So what I'm trying to say in a roundabout way is you have to distinguish between the unobservable concept and the measure we use for that concept. How tall are you, Alec? Well, if you say, Professor, I'm 6'2", I understand because I'm with you. I'm with you. In the United States, we're still with inches and feet. But if you tell me, Professor, I am 10 meters tall, what the heck is that? I don't get it. I have to pull out my cell phone. I have to type how many, what is the conversion rate? And then I say, oh, okay, now I figure, because then I convert that into my comfort zone. So the same thing with return and the same thing with volatility. When you tell me the volatility is 10%, well, what is that? So far in this class, we're using standard deviation. But standard deviation is not the only measure of volatility. Okay? Standard deviation is a measure of volatility, which itself is a measure of risk. Volatility is a measure of risk. So what we want to measure, excuse me. So what we are targeting is how risky is this stock? Well, to answer that question, you have to say, well, this stock is that if you tell me the volatility of this stock is 10%, well, that volatility is not, you are using it as a proxy measure for risk. There are other measures of risk. Okay? Now, there's volatility. But volatility in itself, I'm calling volatility standard deviation because standard deviation is just one measure of volatility. There are other measures of volatility. So you see, we are interested in measuring risk. We use volatility, but volatility is a proxy for risk. It is not the only measure of risk. But even volatility itself, there are many measures, there are many metrics, there are many things we use to measure volatility. Standard deviation, beta, range. There are so many things we use. Okay, so in finance, all of you, in finance or economics or econometrics, whenever you want to solve a problem, you always have to think, what am I solving? Okay, and what am I measuring? I want to measure risk, but look, risk is not observable. So I want to use this to measure the risk of this stock. This thing I'm using is not the only possible measure of risk. There are many. So by the time you begin to make your conclusion, and before you go spend $1 billion based on your measurement of risk using this metric to measure risk, you better make sure that that measurement you are using is kosher, is precise, is good, or is a good measure of risk. Because if that, what you are using to measure for risk, to measure risk, if that thing is not good, and you go spend $1 billion based on that measure because you think, oh, it's a good measure, you're losing your shirt. And then you come back to Professor, but that is what you taught me. Guess what I'll say? I'll say that in class, I taught you, I gave you a single line on that. Don't go make investment based on what I say in class. Okay, all right. So in this class, for chapter 4, we are going to be using variance and standard deviation as measures of volatility. Okay, we're going to be using variance and standard deviation as measures of volatility. Okay, now, so that's why I'm bringing up this first page because for the final exam, I'm going to take questions from what you read from these first few pages. Okay, look at the second line. There are several types of asset volatility. There are several types. Okay, there are several types of asset volatility. The next paragraph, volatility has many important applications in finance. The next paragraph, although asset volatility is well defined, it is not directly observable in practice. What we observe are prices of assets and prices of derivatives. By derivatives, we mean prices of options, prices of futures, of swaps, of forwards. So once you observe prices, then from those prices, you can find maybe standard deviation of price over time. That standard deviation or the variance is a measure of volatility which you want to use to measure risk. But what we observe is price. And when, let me say, for example, there's price of Facebook, the stock, Facebook, but there is price of a call option on Facebook. So we observe the market buying and selling the call option on Facebook. We also observe the market buying and selling swaps, the swaps based on Facebook. We observe the price of the market buying and selling futures contract on Facebook. So we observe price of Facebook and every other derivative whose underlying asset is Facebook. With each of those prices, then we're in business. We can then calculate the volatility of Facebook or the derivatives of. So if I want, for example, to say how risky is Facebook, I can begin with the price of Facebook stock itself, and I can measure the volatility of the price of Facebook, standard deviation, variance. Or I can begin with the price of option, call option on Facebook. And with the price of call option on Facebook, I can calculate the volatility of the price of the option on Facebook. What am I trying to find out? I'm trying to find out how risky Facebook is. I can work with the price of Facebook directly, or I can work with the price of the option on Facebook, call option, or I can work with the price of futures on Facebook, or I can work on the price of forwards on Facebook, or the price of swaps on Facebook, or the price of swaptions on Facebook. So I can use any derivative on Facebook, get the price, calculate the volatility of that derivative, and then make an imputation and then relate it to the price of Facebook, because at the end of the day, I want to find out how risky Facebook is. I want to stop here to ask, have I lost anybody? Does anybody have a question?
So Professor, I have a question about like when you're finding like the value of Facebook, like you're basically saying like no matter how like volatile the price of it itself is, like if you know that it's something that's going to maintain a good value, it doesn't really matter. Like,
okay. Look, Joseph, that's a great question. Okay, what do you mean by it doesn't matter? For example, let me. I hear you. You're correct.
Yep.
Okay, but I want to break it down. Okay, thank you for that question. So, Joseph, why might you and I, Joseph, why might you and I be interested in finding out how risky Facebook is? Why?
Maybe.
Yes, exactly. You don't need to go further. It's like, I want to know whether to buy Facebook or not.
Yeah.
Yes. And if I have Facebook, I want to know whether to exit or not, right?
Yes.
Thank you. So that expression tells me everything. Because I have Facebook and I want to know, should I get out or stay? I want to measure how risky Facebook is. Or I don't have Facebook, I want to buy Facebook. I want to measure how risky Facebook is, okay? Now, Joseph, if I come to you and say, over the past 5 years, the volatility of Facebook has been 2%, but the volatility of the average stock out there has been 15%. Whoa, you say, well, I'm risk averse, right? So I like Facebook. Is that correct? That's what you would say.
Yes.
If you were risk averse,
Yes.
you are not like other people. You are like me. You are risk averse. Okay. Now, but some. Thank you. That's my answer to Joseph. Okay. So I feel, Joseph. So now I feel comfortable with that 2% volatility. But really, is that 2% what is that volatility that I just gave you 2%? Maybe it's standard deviation, yes?
Yes.
Yes?
Yes.
Okay, so if I give you standard deviation and you say, oh, that's good because I'm risk averse, I am going to now invest in Facebook because the standard deviation is 2%. What is the next question? Is standard deviation really the correct measure of risk for Facebook? Because if it is not, Joseph, then you and I, we are kind of in a cloud, right? We're saying, oh, it's safe, but really it's not safe because it is safe based on the measure we use. You agree with me, right?
Yes. Yes.
Exactly. But if I use Alec or whoever asked me that question, if I use spread, or if I use range, which is again spread, or if I use if I use implied volatility, which is the volatility I get from the options market,
Right.
or if I use the VIX index, the changes in the VIX index. I mean, Joseph, if I use any other measure, we would have said, oh my God, this thing is crazy. Whereas the ordinary standard deviation is telling me 2%. But this other measure, whoa, they are telling us, run, don't do it. You understand what I'm saying?
Right. Yes.
Okay. So all of you in finance, that's why somebody was asking me the other day, or people asked me, Professor, do you invest? And I say, no, I don't invest in US markets or whatever. Because for me to invest, I have to be very sure of what I'm doing. Or if I'm not very sure, then I will invest and I have to surround it with a lot of hedge. I used to work with a small hedge fund many years ago. And those people they're so brilliant and they have a lot of money, physicians and all kinds of people. And they will always want me to give them certainty. And it took months for me to convince them that there was nothing. There's a medical doctor, I mean, physician, lots of money, investing lots of money with us. But he was always kind of pushing the bounds. Professor, that's why I'm investing with you because you're a professor of finance. I said, look, I cannot give you 100% certainty. All right. But this is what I'm going to do. When I ask the portfolio manager of the fund to invest, and we all agree that we're all going to invest, then what we do is we hedge. So we make our investment and we hedge. Okay? In case that investment and our comfort zone doesn't pan out. So we hedge. But then, because I'm a finance professor, I know what can happen with hedges. Okay? So it's a long story. But bottom line is this, that when we say volatility models, we're not just going to eat volatility models or be crazily happy about. Why are we modeling volatility? It's because we want to track the risk of stocks. But why don't we go and model risk? Well, we can't observe risk. We cannot observe return. The only thing we observe in the market is what, guys? Is what?
Price.
Price. It's prices, only prices. Now, I can observe price of Facebook stocks directly, or I can observe price of options on Facebook indirectly. I can observe price of, so if I observe the price of options on Facebook, so I'm indirectly observing what is happening to Facebook. If I observe the price of swaps, or forwards, or swaptions, or Madonna options, or double edge. I mean, there's all kinds of options and all kinds of futures and all kinds of so. If I observe, if whatever the derivative is, I can observe the price of those derivatives, and then I can use those prices to measure the volatility of those derivatives, and then try to link it to the volatility of my original target, which the risk of Facebook. Okay, so let me show you on this page here. So on the next paragraph down here, there are many volatility models available in the literature. Okay, there are many of them. The univariate models discussed in this chapter include GARCH, GARCH, and so on and so forth. So what we are going to talk about in this class and in this chapter, they are only univariate. What do we mean by univariate? One variable, and you see it, just one. Okay, but if there was an advanced financial econometrics class, then there I would talk about multivariate GARCH, multivariate ARCH. So when I do my work, I don't do univariate. I used to do univariate, but multivariate will introduce many other dimensions, okay, depending on what problem you're trying to solve. Okay, all right. But let me go on because there's something else I want to show you, and then I'll deviate. Okay, I always ask exam questions from section 4.1 and other sections, but I'm always, so you can take it to the bank. You're going to see questions from this section, okay? All right. So section 4.1, although volatility is not directly observable, but volatility has some characteristics that are commonly seen in asset returns. Remember, returns themselves are not observable in that sense. What is observable is price, and then from there we determine returns. So let's say we are working with simple returns. We know the characteristics of volatility that we can determine by observing returns. Exactly, Danny, you're correct. Stylized facts. Thank you. Man, you guys are just fantastic. You don't need me anymore. Okay. Yes, I like that. So what are those characteristics of volatility that we, even though we don't observe volatility directly, but through returns, we can figure out the stylized facts for volatility. You will see this on the final exam, okay? Number one, there exist volatility clusters. We know that. I've been talking about that from day one, right? Okay. Second, volatility evolves over time in a continuous manner. That is, there are no volatility jumps are rare. What do we mean by volatility jumps? Suppose you and I will begin to draw volatility on the graph. So volatility on the y-axis and time on the horizontal axis. If we begin, let's say we begin from year 1990, and we begin to draw the volatility, okay? We begin to draw the volatility with volatility clusters. Are you guys watching my hand? What am I doing? I haven't stopped to take my hand away from the paper, and then maybe I begin to draw in 1990 day by day, and then in 1995 I stopped, and I pull my hand out of the paper, and I come back in 1996, June of 1996, I resume drawing, right? Then if that is so, what happens between the end of 1995 and the middle of 1996? It will be a blank spot. Are you with me? Something happened. Either Joseph Onochie went to Jamaica and did his stuff in Jamaica and then came back, or I went to Nigeria, or I went to China and drank, you know, whatever, 60, I mean, my favorite drinks. So I took 6 months vacation and I came back and I said, oops, and I resume again. So there'll be a blank space. So from here, I jump, nothing in between to middle of 1996. That is non-continuous. Are you with me? That is There has been jumps. And maybe when I come back, I won't start at the 0 point. Maybe I left off at the end of 1995 at 0.0 for volatility. And then when I come back middle of 1996, I begin at +2. So volatility has jumped, number one, jumped from 1995, end of 95 to middle of 96, and then went up to 2%. We don't usually observe that with volatility, even though it exists. From time to time, you will say it exists, and we call it a structural change. Maybe something happened to the economy. Look, I have brilliant colleagues in my department. Oh my God, those people, I take my hat off to them any day. A couple of them, actually, one of them works in the area of options. He's a world-renowned expert. So I have many colleagues, both in Baruch and the strong ones, my friends in Norway. They work on volatility jumps. So they try to model. Now, if Joseph Onoche left off volatility, drawing volatility in 1995 and came back middle of 1996, how do we connect those two? How do we model jumps? How do we predict when jumps will occur? What are the characteristics of those jumps? There are some professors of finance, statistics, econometrics, and so on, that is their life's work. Okay? But one of the stylized facts about volatility, one of the main characteristics about volatility is that volatility jumps are very rare. They occur, but they're rare. Danny, you had your hand up.
Yes, you said it's very uncommon, but isn't it like more common now with like SPACs?
Exactly. So when we say things are rare, it's like how do you say it? Some things are rare in the past, but suddenly they begin to occur. You've heard the expression once in a blue moon, right? Yes, once in a blue moon events are very rare events. Okay. Sometimes in finance we use the terminology
Black swan.
Exactly, thank you. Black swan. So when somebody says black swan or blue moon, once in a blue moon, we are talking about those things that are very rare. Let me tell you guys, many years ago, before many of you even came to Baruch, were even born, many years ago, to wake up in the morning, let me rewind. This is 2021. I think it was in year not 2019. Was it 2019 or 2018? I forget exact. I think it was 2018 or 20. I don't remember exact year now. But I went to China during the Thanksgiving holiday. Okay, I went to a town called Shuchang in China. I have friends there. And the day before I left, I remember this vividly because the day, I think it was November 11 or 12 or 13, around that area, those days, because that was around the day I left. I woke up in the morning, and for that day, the Dow Jones, the Wall Street lost. In that single 24-hour period, Wall Street lost all the gain that they made from January 1 of that year until November of that date. Within 24 hours, we lost every profit, everything we made for that year in 24 hours. Guys, this didn't used to happen many years ago. That event used to be called a black swan event many years ago. Also, in October 19, I think, I forget the year now, October 19, the Dow Jones Industrial lost more than 20% within one day. Again, don't take my words. go to Google and look at the history. People jumped out of the windows to harm themselves, harm themselves. Because, I mean, you wake up and Dow Jones Industrial lost not 20%, 20 standard deviations. I'm sorry, I misspoke. Not 20%, lost more than 20 standard deviations. That is, it fell not 2 standard deviations, not 3 standard deviations. It fell into the, you know that when we say 99%, we're leaving 1% at the tail. It fell way into the tail. Not 3 standard deviations from the average, which covers 99%, but it fell 20 standard deviations. People harm themselves in the United States because of that loss, because some people lost everything. At that time, I think it was 1986, that was a black swan event. But can I ask you now, Danny, or Alec, or Joseph, or Alejandro,
Go ahead.
these days, if you wake up today and hear that Dow Jones lost 20% of its 20 standard deviations, everybody will say, oh, quel dommage, oh, what a pity. But are you going to jump out of the window? Of course not. Why? Because we have been conditioned in recent years for highly volatile events. Are you with me, right? So what we call black swan, is relative to the period and the history before that period. So one of the characteristics of volatility, so Danny, in answer to your question, yes, it does occur. Volatility jumps are occurring more and more these days. That's why many of my colleagues in different parts of the world that I know, or if you read the finance journals, or econometrics journals, you see many people now trying to model volatility jumps. Okay, but they didn't used to occur before. They are still rare, but this period, their occurrence this period compared to their occurrence in the past is more frequent now. Even though it's rare now, but it's more frequent than before, okay? So number 3, the volatility does not diverge to infinity. That is, volatility varies within some range. What do we mean by that? We have been talking about in this class, when we talk about characteristics of stationarity and that, you know, it's not homoscedastic. It's finiteness, finite. Okay, then homoscedasticity means that the volatility is constant. That's homoscedasticity. If the volatility is 10%, it's been 10% per day for the last 1 year or 5 years or 10 years. It's constant. But finite, meaning it can change, but it will not blow up in our faces infinitely positively or blow up in our faces negatively in the other direction. Okay, so that's finiteness. And then the last one I want to mention is leverage effect. Number 4, volatility seems to react differently to a big price increase and a big price drop, with the latter having a greater impact. In other words, when price, remember, I don't know if I said it in this class, when I use the price of crude oil, if I think last week I gave an example. If the price of crude oil in the world goes up by 10%, by how much does the price of gasoline that you put in your car go up? If the price of crude oil, not refined, crude oil in the global market, if crude oil gains 10% and the gasoline price that you put in your car goes up by 3%. Well, 1 month later, if that price of crude oil falls by 10%, let's say back to its original level, let's just say that is 10%. It went up 10% and your gasoline prices cost 3% more. If the crude oil price comes down loses by 10%, does your gasoline price go down by exactly 3%? The answer is no. Because usually what we observe is when crude oil prices go up by 10%, price of gasoline goes up by 3%. But when when price of crude oil comes down by this exact same amount, the price of gasoline will go down by maybe 1%, not 3%. I know, I see this, and it frustrates me. I live in Princeton area. I take a bus or a train, but especially the bus, how much I pay for ticket to go to New York. Every time prices of crude oil goes up in the world, my bus fare goes up by maybe $2. But then when the price of crude oil falls by the same amount, the bus company doesn't reduce my bus fare by my ticket fare by $2. It stays up. That is what we tend to call leverage effect when we apply it to volatility, to ARCH and GARCH models. So that is the fourth characteristic. Okay, when the price of Facebook goes up by 10%, the impact on volatility, what happens to volatility, is different from what happens to volatility when price of Facebook comes down by the same amount. So if price of Facebook goes up by 10%, and you measure the volatility of Facebook and you track the volatility of Facebook, what happens to volatility is different than what happens to the same volatility when price of Facebook comes down by the same amount. Typically, the impact of price of Facebook going down, the impact of volatility is stronger than the impact when the price goes up. That is what we call the fourth characteristic, or leverage effect. Okay, that's here. These properties play an important role in the development of volatility models because depending on which of these characteristics, for example, if we use standard deviation, if we use variance as a measure of volatility, the variance that you and I have been calculating, the variance that you came across in your basic statistics course, in your ECHO 4000 class, in your investments class, in this class, that variance and standard deviation that we have been calculating, that we have called volatility, which we use as a measure of risk, that variance and standard deviation does not account for all of these four characteristics. Let me say that again. When you and I go to Yahoo and download the price of Facebook, and then we calculate the standard deviation, we calculate the variance, and then take the square root and calculate the standard deviation. That is a measure of, we call it volatility, which we use as a measure of how risky Facebook is. That number that we get, that number doesn't include all of these four characteristics. Particularly, it doesn't include leverage effect. So if that measure called standard deviation and variance that we calculated based on price, it doesn't how do you say it? It doesn't correct for leverage effect. It doesn't correct for particularly the leverage effect is a major problem. So generally, if we want to create an equation using that volatility, so that equation will make that volatility correct for leverage effect, our simple ARCH model and our simple GARCH model is not enough. We have to introduce some other, a little bit complication, some other extension to the equation, so that we say, okay, because we have introduced this extension, then the variance that you calculated, if you use the variance in this particular type of equation with that extension, then we can account and correct for leverage effect. Okay, because if you don't add that extension, And if you use the variance that you calculate from Yahoo prices to determine the coefficients of the ordinary arch equation, and then you use that equation to predict volatility, and then based on that prediction, or you say, okay, I predict based on having done this regression and gotten the coefficients, and I use it to predict what the variance will be for tomorrow. So let me go spend $1 billion based on that concept. Then that $1 billion you can lose it because of leverage effect. Because the normal equation that you use does not correct for leverage effect. So if you want to be confident that you are handling leverage effect, you have to tweak that equation a little bit. And that tweaking, that new equation that we use to correct for leverage effect, I will introduce you to that equation next week. Yes, Danny, you have your hand raised.
Yeah, I just want to know where the leverage effect and the gain loss asymmetry diverge, because
Yeah,
you can think very similar.
Yeah, you can think of them as the same thing, but the gain loss asymmetry we are applying to financial prices and returns, but not to volatility of those returns. When we talk about volatility, we talk about them in terms of leverage effect. So you can think of it as gain loss asymmetry of some type. Okay?
Yeah, helps.
Okay, so when we were discussing stylized facts, so some of you must have noticed my tongue slipped. I used the term leverage effect. Remember the day I was discussing the midterm exam? I remember particularly I said leverage, but then it occurred to me that we were not talking about arch and GARCH models. So I said, oh, gain loss asymmetry. Okay, so gain loss asymmetry we use more for prices and returns. Okay, but it's the same concept, and that's a great point. Okay, all right. So please read this. Okay, just one more thing. In practice, this paragraph. In practice, we typically estimate volatility of an asset using the prices of its stock or derivatives or both. So let me say that again. Remember, price is what we observe. But price of what? If I'm interested in measuring the risk of Facebook, I can collect the prices of Facebook, and from the price, I can download the prices from Yahoo, and from those prices of Facebook, I can measure volatility as a measure of risk of Facebook. If I want to be a little bit more confident, then I can do that. And also I go take, if we are in the United States market, or in the market for China, or in the market in France, or in a market where we can find where options on Facebook are traded, then we can collect the prices of the options on Facebook. Because don't forget, if there are 5,000 stocks trading in the United States, both NASDAQ and New York Stock Exchange and so on, it's not for you cannot find options on those 500 stocks being traded in the markets. All you have to do is look at the just Google, or look at the New York Stock Exchange, or look at the Chicago Board of Options Exchange. It's just only a handful of stocks in the United States for which options on those stocks are traded. So if I want to trade the options on a mid-sized public company, you may not find the options. Chances are you will not find anywhere in the United States or anywhere in the world where the options on the stock of that company is traded, because it's just a few companies for which options, futures, forwards exist on those companies. Okay, so but if they exist, if the derivatives of those stocks exist, then you can observe, you can collect prices of Facebook, prices of call options on Facebook, prices of put options on Facebook, prices of futures contracts on Facebook, because call options, put options, and futures, there are market prices, prices determined by the market, supply and demand, and those prices are available for you and I. Those prices are available in the market. For forward contracts, the price of forward contracts because forward contracts are over the counter. They are not available publicly to everybody. But for call options on Facebook, put options on Facebook, and futures contracts on Facebook, there are exchanges where we can go and download these prices. So with those three derivatives, so you can, if you want to find how risky Facebook is, you can download the price of Facebook from Yahoo. You can download the price of call options on Facebook from Chicago CBOE. You can download the price of put options on Facebook from CBOE. You can download the price of futures on futures on Facebook from CFTC or wherever, futures exchange somewhere. And then using those four market determined prices, you can then do all kinds of econometrics, nuclear physics to try and track how risky Facebook is. Okay, so that's what is being discussed here. Okay, these bullet points. So you can measure volatility of IBM from Facebook prices, from Yahoo prices, or implied volatility from Black-Scholes formula from options prices, or the next bullet point, or realized volatility. You can find them by tick by tick, minute by minute prices. So there are fundamentally 3 or 4 ways we can actually measure. We can actually get actual prices, market determined prices, and track the risk of IBM. We can do it from Yahoo prices, or from implied volatility prices, or from minute by minute prices. And minute by minute and second by second prices, we have all that data in my department at Baruch. So every minute, we call them tick by tick. Every transaction and every minute, the price of IBM during the day for the past 20 years, we have all of those in my department. Some of my colleagues do research with those prices. I mean, the programming effort you need, because it's millions of data points we use. We call them trade and quote data, TAC data. We have them all in my department, and we use them for research. Okay, so Danny, you have question. You raised your hand.
Professor, you said download pricing from like Yahoo and whatnot. Isn't the option pricing formula like it doesn't involve probabilities though?
It does.
Understanding like whether it moves up or down, because it's already incorporated in the underlying security, no?
It does. I mean, have you taken a class on options?
Yeah,
Black-Scholes, right?
I had to open my book just to make sure, and I'm reading this right off the.
Yes, Black-Scholes option pricing model is SNE. You know, there's that N. If you look at the Black-Scholes option pricing, that N is the normal distribution. That's where the probability comes in. That's stochastic. So it's SNE to minus R delta T minus X XE to the minus X is the exercise price in the Black-Scholes equation, minus XE to the minus RT. All of those N you see there, we are picking from the normal distribution. That's where probability comes in. So I know exactly what you're looking at. So in the Black-Scholes option pricing formula, the N and then the D1 and D2, they are all probability from the normal distribution. So that's where the uncertainty comes in. Okay, Danny? All right, just hold on. I have to run round up my class. Okay, guys. So I have put on Blackboard my handwritten stuff on GARCH. I'll go over that on Thursday. You don't have to look at it today. But so on Thursday, I'll introduce to you the ARCH and GARCH models and how we test for whether there's presence of ARCH and GARCH. Danny, okay? All right, so let me stop recording and then I want to make an announcement. Just a quick announcement. So everybody bear with me. So again, thank you for your comments and your questions. So
The recording has stopped.
okay, so I kind of gave you a background of why we're doing what we're doing because volatility is not observable, returns are not, is really prices we observe. So whatever we're doing, we want to track what happens to the particular stock and the prices. Okay, so the equation we're going to be using for volatility would be how we try to track the risk of those stocks. All right, today after class, I don't have time to stay and talk to many of you. I think I made just one appointment for after class today. I apologize for that because I have to run to go do some stuff. But if you need to see me, just send me an email and then I will arrange to see you after class next Thursday or next Monday, or even if you are able to talk to me on a Saturday or Sunday, I'll be able to give you a few minutes, okay? Depending on what the weekend is. But definitely if you send me an email, I can see you after class on Thursday and also on Monday evening, because Monday evenings work best for me. Monday is a non-class day. This class is a non-class day, but I can work with you in the evening and then also Tuesday. So if you can't talk to me tonight because I haven't made the appointment with you, I can talk to you on Thursday after class or next Monday or next Tuesday. Nadia, you have your hand raised.
Yes, Professor, quick question regarding group project. So if we don't have a partner, do we have to find one or you will be able to assign one for us?
Yes, I'll be able to assign one to you, but I need all of you who can find partners. Please send them to me. I beg you by the end of midnight day today, please, so that I will know who does not have partner and then I can assign, okay? I'm already trying to assign people to partners who I know don't have partners, but please try as much. My preference is that you choose who you'll be working with. That's my preference. Okay, but again, because I know many of you in the class, I can pair you up. I already know that some of you tell me, Professor, I don't have a partner. You told me that like 2 weeks ago, and then I can pair you up. But as much as possible, you know, I could have just randomly assigned you guys to team members. Blackboard does it in 1 minute. So it's easy for me. Okay, this is the difficult part I'm taking by asking you to choose your own partners, because if you choose your own partners, maybe you can find somebody you're friends with and you think alike, your schedules match and so on and so forth, you can work well with. But those of you who cannot find, that's okay. Don't worry about it, okay? When I was a student, I would never bother. The professor will always find somebody for me. But if you can't find, either because you don't want to bother or because you don't care or because you tried but you couldn't find, then I'll do it for you. But after tonight, when the TA and I have collected all the names, and then the TA will organize them maybe tomorrow, and then maybe by the next class, I'll see who doesn't have a team member, and then I'll do the assignment. I'll try to do the assignment. Okay, Nadia, does that answer your question? All right.
That's perfect. Thanks.
Okay, excellent. Danny. Okay, guys. So look, I'll see you all on Thursday. Okay. But on Thursday, I will introduce the ARCH and GARCH models, and then beginning next week, I can do, and then I can do Excel and R and so on and so forth. Okay. All right.
Professor, up to what section do you want us to read up to, or just
if you can, in the textbook up to section 4.5.
Okay, thanks.
Okay, that's for those of you who can read it. And Danny, you can send me an email tonight, and if I have time, I'll let you know. We can meet as usual. Okay.
Noted.
Okay. Bye, guys.
Bye,
Okay.
Professor. Thank you.
Okay. Thank
Been
you.
on the
Bye,
same
Ian.
slide.
Bye.
Oh, now he has
CJ.
sent it.
Bye, William.
Bye, Professor.
Bye, guys. Bye.